Hello, everyone. Taking a look at the markets today, Sunday, November 16, 2025. We do need to note that live trading is, of course, closed for the weekend. So, looking at the last trading session, which was Friday, November 14, we saw Hyperscale Data Inc. close at 28 cents per share. That was a pretty significant drop, finishing the day down $0.23, which translates to a 7.60% loss on the session. Now, the immediate expectation when you see a 7.6% drop on a sub-dollar stock is to just brush it off. It's the penny stock world. Volatility is the name of the game, and swings like this happen on almost no news. Most people see that 28-cent price tag and the sharp red candle and think, typical, probably just a few retail traders on the Robinhood app dumping their position. But the reality here might be something far more structured. That 7.6% move wasn't just noise. When we look at the trading patterns from Friday, the selling pressure was consistent, almost programmatic, suggesting it wasn't just panic selling. This could be a sign of a larger stakeholder repositioning or perhaps a response to quiet filings that the broader market hasn't priced in yet. That 28-cent level might be a temporary floor, or it could be the trap door. The common belief around Hyperscale Data Inc. is pretty straightforward. You see the name Hyperscale and you immediately think of the massive AI and cloud boom. You think of the seemingly endless demand for data centers, the infrastructure that powers everything from your SoFi banking app to the complex models being run by NVIDIA stock. The expectation is that this company, even as a microcap, is a lottery ticket. A way to get in on the ground floor of this massive build-out, something that feels more explosive than just buying Apple stock or Tesla stock. People are looking at this as a speculative investment for their individual brokerage account, hoping to catch a fraction of the updraft. But the challenge to this belief, the hard reality, is that building data centers is brutally expensive. This isn't just about writing code, it's about land, power, cooling, and hardware. The name is aspirational, but the business model is a black hole for capital. The real question isn't, can they ride the AI wave? It's, can they even afford to build a surfboard? Let's break down that recent price action from Friday. The 7.6% drop wasn't on massive, overwhelming volume, but it was significantly higher than its 10-day average. This tells us a couple of things. It wasn't a fat finger trade, and it wasn't just a lack of bids. There was real, motivated selling. When a stock that's part of a popular narrative like this one sells off on high volume, it forces you to ask who is selling and why. Is it an early-stage fund whose lockup period expired? Are they seeing something in the company's cash flow burn rate that they don't like? This is the kind of investment help you won't get from a standard screener. You have to look at the tape. The stock gapped down slightly at the open and then just bled out all day with very weak bounces. This is often a sign that institutions are parsing out their sell orders, trying not to crash the price all at once. Retail traders using SoFi Invest or Robinhood stock trading might have been trying to buy the dip, but they were met with a steady wall of supply. This contrasts sharply with the broader sector. While NVIDIA stock and other large-cap tech names found their footing last week, Hyperscale just sank. This tells us the weakness was specific to this company, not a sector-wide problem. This makes the investment thesis much riskier. It's not a rising tide lifts all boats situation. This boat has a specific leak. For anyone practicing self-investing and managing their own portfolio, this is a critical distinction. You can't just buy a basket of AI stocks and hope for the best. Some, like the established players you'll find in Fidelity ETFs, are built for the long haul. Others, like Hyperscale, are pure speculation. This is why platforms like Schwab Intelligent Portfolios or a Fidelity Wealth Management Service would likely never include a stock like this. The risk-adjusted return is just too skewed. So what does Hyperscale Data Inc. actually claim to do? Their filings state they are in the business of identifying, acquiring, and developing sites for next-generation hyperscale data centers. They plan to service the explosive demand from cloud providers and AI research firms. The model is part real estate, part high-tech infrastructure. In theory, it's a brilliant business to be in. The reality is they're competing with Amazon, Google, Microsoft, and a host of deeply capitalized, specialized REITs, real estate investment trusts, that already have the connections, the supply chains, and the balance sheets to build at scale. Hyperscale Data, by comparison, is a startup with a handful of employees and a corporate presentation. Their performance history is what you'd expect: extreme volatility. The stock was trading near $1 earlier this year on pure hype and has been in a downward channel ever since as the capital-intensive reality set in. Older reports show a pattern of raising cash through convertible notes and private placements, which often leads to dilution, meaning your piece of the pie gets smaller as the company issues more shares to stay afloat. This is a critical point for anyone thinking about online investing. When you use investing sites to look up a stock, you see the price, the chart, and the news feed. What you don't see is the capital structure. You don't see the warrants, the options, the convertible debt. A sophisticated trader using the Interactive Brokers trading platform can dig into those filings and see the overhang. They know that even if the company succeeds, a flood of new shares could hit the market, keeping the price suppressed. This is a far cry from the safety of Fidelity mutual funds or even the managed risk of a SoFi robo-advisor. It's active, high-stakes speculation. The Fidelity mobile app might make it easy to buy, but that ease of access masks the extreme risk. Now let's talk about the future outlook framed by this tension between expectation and reality. The bull case, the expectation, is that Hyperscale Data lands a single significant contract. Maybe a secondary cloud provider or a new AI startup needs a specialized facility, and Hyperscale manages to secure the land and the funding. If that news hits, this 28-cent stock could, in theory, go to $1 or $2 overnight. The low float and high retail interest on platforms like Robinhood would act as gasoline on a fire. Traders see the low price and the fractional shares availability and think, why not? I'll risk $100. That collective why not can create massive short-term squeezes. They might even be looking at its potential for Robinhood crypto investors who are used to that kind of volatility. But the bear case, the reality, is far more probable. The company is burning cash. They have to pay for salaries, legal, and filing fees, all while trying to put together multi-hundred-million-dollar land and construction deals. Where does that money come from? It comes from more share offerings, more dilution. The 7.6% drop on Friday could be the market beginning to price in another round of financing at even a lower price. The major risk here is insolvency. They simply run out of money before they ever break ground. This is the danger of online investment without deep due diligence. What looks like a cheap stock is often a failing company. The institutional platforms like Fidelity, Interactive Brokers, and SoFi all provide access, but they don't all provide the same level of analytical depth. A professional using Interactive Brokers trading tools is looking at cash flow statements. A hobbyist using the basic Robinhood app might just be looking at the one-day chart. So what are the catalysts to watch? First, their next quarterly report. Forget the earnings. Look at the cash balance and the burn rate. How many months of runway do they have left? Second, any announcement of partnerships or joint ventures. This is their most likely path forward. They can't fund this alone. They need a deep-pocketed partner. And third, watch the interest rate environment. For a capital-heavy business like this, higher rates are a death sentence. It makes their borrowing costs impossibly high. For a stock like this, You're not just a stockholder, you're a venture capitalist. It's a high-stakes game. This isn't like managing Fidelity IRAs where you set it and forget it. This is hands-on daily watch list material. It's the kind of stock that many Fidelity brokerage clients are warned about, while many Robinhood investment traders are drawn to. Speaking of which, I'm curious what you all think. This is a very binary play. Comment below with gem or trap. Do you think Hyperscale Data is a hidden gem that's about to be discovered, or is it a classic penny stock trap waiting to spring? In summary, the 7.6% drop in Hyperscale Data to 28 cents is far from a simple, noisy move. The expectation is that this is a cheap, speculative way to play the AI data boom, a narrative as powerful as the one that drove Tesla stock for years.